Stop looking at the spot price on your phone. If you are looking at the ticker tape in New York right now, you are looking at a lie. You are looking at a ghost. For 40 years, the Western financial system has operated on a single unspoken premise that the paper derivative of an asset is equal to the asset itself. That premise just broke. While the digital ticker in New York flashes $74.89, the industrial reality in Shanghai is trading at a physical premium that converts to roughly $80 an ounce. This is not a glitch. This is a $5 fracture in the global financial spine. In the world of high-frequency arbitrage, a 5-cent gap is an opportunity. A $5 gap is a structural failure. It signifies that the mechanism used to suppress the price of real money, gold and silver, has finally snapped. We have seen this pattern before. It echoes the collapse of the London gold pool in 1968, when the market demanded physical metal that central banks did not have. Today we are inside what traders call Ghost Week, the dangerous liquidity vacuum between Christmas and New Year's. The senior risk managers have left the building. The algorithms are running wild in a vacuum of liquidity. We are witnessing the beginning of a liquidity crisis that historians will likely record as the moment the paper market lost control of the physical price. The flow of silver has reversed. It is no longer circulating in the West. It is teleporting to the East to close the arbitrage gap. The question is, not when will the crash happen? The question is, why do you still believe the price in New York is real? This investigation analyzes the mechanics of the December liquidity crisis. We will dissect the math of the Shanghai spread, the breakdown of U.S. bullion dealers who cannot find metal to restock, and the historical inevitability of this wealth transfer. The system is correcting itself, and it does not care if you are prepared. You see the price of silver trading at $74.89 on your screen. You see the green candles, and you assume you are seeing the whole picture, but you are not. You are looking at a ghost. What is commonly referred to as the spot price is merely a paper derivative market that is currently being strangled by a liquidity crisis, the likes of which we have not seen in 40 years. When you see that ticker, you are viewing a contract for 5,000 ounces of silver that, in the vast majority of cases, never sees physical delivery. It is a digital promise, a wager on price direction, settled in cash. But if you want to know the real price of silver, if you want to know the price that the industrial giants of the world are actually paying to secure metal for production, you have to look 5,000 miles to the east. You have to look at Shanghai. Right now, as we speak, the physical silver market in China is trading at a premium that converts to roughly $80 an ounce. To understand the severity of this, we must do the math on the Shanghai Gold Exchange. While the U.S. market was effectively closed for the holidays, the Chinese market was trading, and the panic there is palpable. The benchmark price hit roughly 595 yuan per gram. When you convert that to dollars and ounces at current exchange rates, the base price is $77.20. However, that is just the exchange price. If you add the value-added tax and the physical delivery premiums being charged on the street in manufacturing hubs like Shenzhen, the real cost to get metal in your hand is over $80. That is a $5 gap between New York and Shanghai. In the world of global finance, a 5-cent gap is an arbitrage opportunity. A $5 gap is a broken market. It means the arbitrage mechanism, the machinery that keeps prices equal around the world, has snapped. In previous cycles, such as the crash of 2011, the paper markets in the West utilized margin hikes to smash the price down, forcing physical holders to. Today, the dynamic has inverted. The paper price is broken, and the physical price is taking over. The metal is flowing one way, and the price in New York has no choice but to teleport higher to close the gap. Why is this fracture happening now? To understand the timing, you have to understand the mechanics of the calendar. Wall Street is a human institution run by people, and the last week of December is the only time of the year when those people disappear. This is what traders call Ghost Week. The senior trading desks at major banks like JP Morgan, Goldman Sachs, and Citibank are currently staffed by skeleton crews. The risk managers are asleep, and the floor is left to junior traders, interns, and algorithms set to passive. The liquidity, the ocean of buy and sell orders that usually absorbs volatility, has evaporated. Imagine a swimming pool. Usually the pool is full of water. If you jump in, the water level barely rises because the volume absorbs your impact. That is a liquid market. But today the pool is empty. If you pour a single bucket of water into it, it splashes everywhere. That is an illiquid market. This morning we saw a massive buy order hit the silver market that pushed the price from $71 straight to $74.89. It moved $3 in a straight line. Why did this happen? Because there were no sellers. The ask side of the order book was completely empty. The banks were not there to defend the price or absorb the blow, so the price simply teleported. This is the danger and the opportunity of Ghost Week. When a motivated buyer, like a Chinese industrialist desperate for inventory, enters this vacuum, they encounter zero resistance. They can push the price up 5 or 10% without even trying. The algorithm sees the empty room, realizes there is no inventory, and runs for the exit. We are watching a vacuum melt up. The New York spot price you are staring at is no longer a leading indicator. It is a lagging indicator. The real price discovery has migrated to Asia, driven by the physical necessity of battery makers and solar manufacturers. The US viewer looking at their brokerage app is effectively watching a delayed broadcast of a game that is already finished. The spread exists, the metal is moving, and the New York price must eventually reconcile with the reality of $80. But as the price teleports, it triggers a chain reaction in the physical supply chain that most Americans are not prepared for. Let's look at the math that is breaking the system. It is simple, brutal, and undeniable. As we established, the price in New York is hovering around $75. The real price in Shanghai, after premiums and conversion, is $80. This creates a $5 gap per ounce. In the high-speed world of global finance, this is what is known as an arbitrageur's dream. The trade is elementary. You buy a contract in New York for $75. You take delivery. You sell that same metal in Shanghai for $80. You make $5 risk-free. In a functioning market, this activity is healthy. The arbitrageurs buy in the cheap market, raising the price, and sell in the expensive market, lowering the price, until the two equalize. But today, the machine is broken. The gap is not closing, instead it is widening. Because the physical supply in the West is critically low, this arbitrage trade is not acting as a stabilizer. It is acting as a vacuum. It is sucking every available 1,000-ounce bar out of the vaults in London and New York. It is putting them on cargo planes and flying them 5,000 miles to the east. To understand the gravity of this flow, we must look back to the 19th century. We are witnessing a reversal of one of the most significant economic trends in history. 200 years ago, the British Empire faced a crisis. Their silver reserves were bleeding into Qing Dynasty China to pay for tea, silk, and porcelain. The West had the paper currency. The East had the goods. The result was a massive transfer of real wealth. Silver from the vaults of London to the treasuries of Beijing. Today, the geopolitical strategic assets have changed, but the direction of the flow is identical. Silver is no longer flowing to China to pay for tea. It is flowing to secure dominance in the energy infrastructure of the 21st century. Solar panels and electric vehicles. The parallels are terrifying for Western planners. Just as the British Empire's treasury was depleted by its trade deficit with the East, the U.S. Strategic Industrial Reserve is being hollowed out by this arbitrage gap. The metal is leaving, and once it enters the Chinese industrial complex, it does not come back. Do not mistake this for a simple market inefficiency. This is state-level policy. This is economic warfare disguised as market dynamics. China is actively engaged in a strategy of de-dollarization. They hold over $700 billion in U.S. Treasury bonds. Paper promises that are being devalued by inflation and debt issuance. They are systematically exchanging these depreciating paper dollars for strategic hard assets. By maintaining a higher bid for silver, by paying $80 when the U.S. pays $75, China is effectively conducting a hostile takeover of the global silver supply. But this is not just about making money. It is about control. Silver is a critical component in high-tech missiles, satellites, and military guidance systems. If China controls the physical inventory of silver, they control the pace of Western technological development. They can starve the U.S. defense industry of raw materials. It is a brilliant trade. They get rid of the paper debt they no longer want and acquire the strategic resource they desperately need. This brings us to the inevitable conclusion of the liquidity break. New York has lost control. The price in New York has no choice but to rise. $75 is not high enough to stop the drain. $78 might not be high enough. New York has to go to $80 or higher just to stop the bleeding. This is simple physics. If the price in New York remains lower than Shanghai, the arbitrageurs will continue to empty the Western vaults until there is literally nothing left. A price of $75 implies a stable market, but a $5 spread implies a broken supply chain. The market is trying to heal this fracture by repricing the asset higher. The laws of supply and demand dictate that the price in the West must teleport to match the East to neutralize the arbitrage. Until that happens, the vacuum stays open and the wealth transfer continues. But let's leave the abstract world of international arbitrage and look at the street price in America. You might look at your screen, see $75, and think, great, I will buy silver. Good luck. Go to a major U.S. bullion dealer website right now. Look at the Silver Eagles. Look at the 100-ounce bars. You will see one of two things: out of stock or a pre-order for late January. And if they do have metal, look at the price. They are charging $90 for an eagle. They are charging $82 for a generic bar. Why the disconnect? Is it greed? Perhaps, but mostly it is terror. Dealers are terrified of replacement cost. Here is the mechanism that is seizing up. When a dealer sells you a coin, they have to hedge. They sell you the physical ounce, and simultaneously they buy a paper contract to lock in the price. This is how they protect themselves from volatility. But during Ghost Week, the market is thin, dangerous, and the spreads are wide. If a dealer tries to buy a hedge right now, they get ripped off on the price. The cost of hedging has skyrocketed, so they pass that cost on to you in the form of a higher premium. Worse, they face settlement risk. If the exchange halts trading or declares force majeure, the dealer's hedge becomes worthless, and they are left holding the bag. So, dealers stop trusting the paper market to protect them. And if they can't hedge, they won't sell. They effectively freeze operations or price their inventory so high that you go away. This is exactly like the stagflation crisis of the 1970s. The posted price of gasoline didn't matter if the pump was dry. We are witnessing the return of rationing, not by government decree, but by price and availability. While retail investors struggle to find coins, a much larger panic is unfolding on the factory floors of the world's industrial giants. For 30 years, global industry operated on a philosophy called just-in-time delivery. It meant companies like Samsung or Tesla didn't hold inventory. They trusted the supply chain. They ordered silver paste on Tuesday, and it arrived on Wednesday. That trust is gone. The Shanghai premium proved that the supply chain is broken. We are seeing a massive psychological shift to a new philosophy. Just in case, corporate procurement officers are no longer buying for next week's production. They are panic buying for next year's survival. This demand is price inelastic. Consider Tesla. If they are building a $50,000 Cybertruck and the silver required for its electronics doubles from $100 to $200, does that kill the demand for the car? No. Does Tesla stop the assembly line? No. The cost of stopping the line is millions of dollars an hour. The cost of paying an extra $5 or $10 for silver is peanuts. So, the industrial buyer is a forced buyer. They are not speculating on a profit, they are buying to keep the lights on. This is creating a shadow inventory. We are seeing reports of massive off-market block trades, deals where a battery maker calls a refiner directly and buys their entire output for January, bypassing the public exchange entirely. The silver that used to sit in the COMEX vaults is disappearing into corporate stockpiles in Seoul and Texas, never to return to the market. You would assume that with prices at $75, mining companies would be flooding the market with supply. They are not. In fact, we are seeing the opposite, a supply strike. Imagine you are the CEO of a silver miner. You see the price rising, but you also see your costs exploding. Energy is up, labor is up, and taxes are up. You also see the momentum. Why would you sell your silver to the COMEX at $75 today when the chart suggests it could be $100 in January? So miners are withholding production. They are stockpiling bars at the mine site, waiting for the banks to beg. Furthermore, they can't just ramp up production even if they wanted to. 70% of the world's silver comes as a byproduct of lead, zinc, and copper mines. Unless the world needs more zinc, miners won't dig just to get the silver. The pipeline is drying up from both ends. The industrial buyers are hoarding what is available, and the producers are tightening the tap. The banks are standing at the end of the pipe with a bucket, waiting for a drop that isn't coming. This is the definition of a physical freeze. The paper market is trading numbers, but the real economy is running out of metal, and when the physical supply stops moving, the price has no ceiling. While the physical market is freezing up, the paper market is melting down. We are currently witnessing a phenomenon known as a gamma squeeze, centered on the critical price level of $75. In the options market, $75 is a massive strike price, where banks have sold millions of ounces worth of call options. As the price approaches and breaches this wall, the banks enter a state of negative gamma. In plain English, this means they are short volatility. To hedge themselves and avoid catastrophic losses, their algorithms are programmed to buy futures contracts automatically. The dangerous part is the feedback loop. The higher the price goes, the more they have to buy to remain hedged. If the price crosses $75, the bank algorithms trigger a wave of buying, which pushes the price to $75.50, which triggers more buying, pushing the price to $76. In a normal market, humans would sell into this rally to take profit, slowing it down. But in the thin holiday market of Ghost Week, there are no humans. There is no resistance, so the algorithms just chase each other up the ladder. We are watching a programmed melt-up, where the banks are forced to bid up the price of the very asset they are trying to suppress. This gamma squeeze is being accelerated by a structural anomaly called backwardation. This is rare, and it is the death knell of a functional futures market. Usually markets are in contango, meaning the future price of silver is higher than the spot price to account for storage and interest. But right now, in Shanghai and occasionally in New York, the spot price is higher than the futures price. This screams shortage. The market is effectively saying, I do not want a promise of silver next month. I want the silver right now, and I will pay a premium to have it in my hand today. Backwardation proves that the physical collateral backing the paper market is gone. It forces short sellers to cover immediately because they cannot roll their positions to the next month. The cost of the roll is too high. However, we must look at history to see the danger. In 1980, the Hunt brothers cornered the silver market, driving prices parabolic until the regulators changed the rules and the banks engineered a crash. The banks today are trapped, but they are not dead. Because the market is thin, it can be manipulated in both directions. While the trend is up, the banks may attempt a rug pull, a single massive sell order designed to crash the price from $75 back to $72 in seconds. This is not a change in trend, it is a stop hunt. The algorithms know exactly where your leveraged liquidation price is, and they will hunt you. This is why you cannot use leverage in this market. If you are on margin, a $2 drop will throw you off the bucking bronco before the price recovers. The only way to survive the squeeze is to hold physical metal or unleveraged positions. If you have no debt, you cannot be liquidated. You can watch the price drop and laugh, knowing it is just a whale splashing in a shallow pool. Finally, to understand why the price is likely to go much higher than $75, we have to look at the master clock of the precious metals market, the gold-silver ratio. While we are fixated on the $75 silver price, we are missing the signal from the king of metals. Gold is trading at $4,500. This is the anchor. If you think silver is expensive at 75, you are doing the math wrong because you are comparing silver to the dying dollar. You should be comparing silver to gold. Let's do the math. 4,500 divided by 75 equals 60. The ratio is 60 to 1. It takes 60 ounces of silver to buy 1 ounce of gold. Historically, this is still incredibly high. In the 1980 mania, the ratio fell to 17 to 1. In the 2011 run-up, it fell to 30 to 1. Geologically, the ratio of silver to gold in the Earth's crust is roughly 8 to 1. This tells us that even after this massive vertical rally, silver is still undervalued relative to gold. It is the cheapest asset in the precious metals complex. The smart money looks at this ratio and sees mispriced beta. They calculate that even if gold stays flat, silver has 50% upside just to return to the historical average of 30 to 1, which would put the price at $150. This arbitrage between the two metals provides a concrete floor under the price. The algorithms are buying silver not because they like it, but because the math demands it catch up to gold. We must now address the engine driving this entire phenomenon. It is not just about a shortage of silver. It is about a surplus of debt. We are witnessing a historic flow of capital from paper assets to hard assets. For 40 years, the winning trade was to buy bonds and stocks, financial assets that represent promises to pay. But with U.S. debt now exceeding $36 trillion and interest payments consuming tax revenue, the promise is broken. The world is realizing that the only way the debt gets paid is by printing money, making inflation the default setting. Capital is fleeing the burning building of the bond market. It is looking for a fireproof safe, and that safe is commodities. However, there is a problem of scale. The global bond market is valued at over $100 trillion. The entire investable silver market is worth less than $300 billion at current prices. This is a mathematical impossibility. You cannot fit $1 trillion of panic capital into a $300 billion container. The container has to expand. The price of silver has to rise to create enough market cap to absorb the fleeing capital. This is why we say silver must go higher, not because of speculation, but because the laws of financial physics require it. To accommodate the exodus from bonds, silver has to become a $1 trillion asset class, which places the price well over $200. As this repricing occurs, we will witness a psychological inversion known as the Giffen-Good effect. In normal markets, higher prices kill demand. But in a currency crisis, higher prices create demand. When the public sees silver jumping $3 a day, they don't think it's too expensive. They think it is saving me. They see their cash losing value at the grocery store while their silver gains value on the screen. The higher silver goes, the more they want it. It becomes a status symbol, a badge of financial intelligence, signaling that they got out of the dollar in time. This is the modern manifestation of Gresham's law. Bag money drives out good. As confidence in the fiat system wanes, people hoard the good money, silver, and spend the bad money, paper dollars, as fast as possible. We are seeing the death rattle of a fiat currency system. This psychological feedback loop is what drives the mania phase. We are currently just entering the foothills of this mania. When your Uber driver asks you about silver, that is the top. Right now, your Uber driver is worried about gas prices. We are early. This brings us to the most critical part of this investigation, the exit. When your portfolio shows massive green candles, a voice in your head will scream at you to sell. It is the voice of the old normal, beaten down by 40 years of bank manipulation. You must ignore that voice. Selling your silver for dollars right now is the most dangerous trade you can make. Why would you trade the scarcest, most strategic industrial metal on Earth for a piece of paper that the government prints by the trillion? The dollar is the burning building, silver is the fire exit. If you sell at $75, you are running back into the fire because you found a few extra dollar bills on the floor. The smart money does not sell for cash. They know cash is a melting ice cube. Instead, you must change your mindset. You are not trading silver, you are banking in silver. So when do you exit? You do not look at the dollar price, you look at the gold to silver ratio. This is your map. As long as it takes more than 40 ounces of silver to buy 1 ounce of gold, silver is undervalued. You hold, you accumulate, you ignore the volatility. When the ratio hits 30, the market is getting frothy. You pay attention. When the ratio hits 15, this is the signal. At 15 to 1, silver is historically overvalued relative to gold. At that specific moment, you walk into the dealer, hand over your silver, and walk out with gold. You do not touch a dollar. You do not trigger a taxable event in fiat. You simply swap the volatile asset for the stable asset at the peak of the cycle. By doing this, you could effectively triple your gold stack for free. This is how dynastic wealth is preserved. We are currently at 60 to 1. The ratio is screaming buy, and we have a long way to go before we even consider the exit. The Boxing Day breakout was not a fluke. It was a mathematical inevitability caused by a system that sold more paper promises than it had physical metal to honor. The arbitrage gap with Shanghai is the new gravity. As long as that $5 spread exists, the metal will flow and the price will rise. The banks have finally lost the ability to suppress the price because they have lost the physical collateral required to do so. For 40 years, they controlled the lever. Now the lever is snapped. They are no longer the conductors of this market. They are merely passengers on a train they used to drive, and that train has no brakes. As we cross the threshold into 2026, the volatility will be nauseating. The psychological warfare will intensify. They will try to shake you out. They will use the media to convince you that $80 is a bubble, even as the dollar loses its purchase on reality. Do not be distracted by the noise of the machine breaking. Watch the flow of the metal. History shows that wealth is never destroyed. It is merely transferred. We are witnessing a historic transfer from the impatient to the patient, from the paper holder to the physical holder, and from the West to the East. The liquidity crisis has begun. The Shanghai price is the target. The wealth transfer is the result. Position yourself accordingly.